I think the cost of debt is going to go up a little bit this year, but the availability is going to continue to be very good. Is that a good thing? I don't know. It's certainly good for the people who want to lend into the real estate market, but this is a bit of a touch and go situation for those that want to make investments with too much debt. It will really impede the financial flexibility of investors when the market finally turns. In terms of cap rates, there'll be a little pressure on cap rates, but I think that the demand for equity investments in real estate is very, very high right now. And again, I think that many investors are prepared to make investments using low or no leverage.
So with respect to debt, availability is not an issue, I don't think. We've definitely not seen a lack of availability in terms of financing. Obviously, if interest rates continue to rise and if the Bank of Canada has continued successive increases, cost of debt will rise. And in terms of how that impacts cap rates, in theory, cap rates should go up in response to rising interest rates, but I think definitely in the retail sector, we've continued to see a disconnect between the investment market and the equity market. So, we may or may not see a significant increase in cap rates in response to interest rate rising.
We've already seen interest rates go up in 2018, and my expectation is we will see bond yields continue to climb. A force against that trend is that credit spreads have narrowed a bit, so the cost of borrowing to a borrower like ourselves has been less of an increase than we've seen in the bond yields. I expect the supply of debt to remain very fulsome. Lots of lenders have lots of capital to put to work. The unsecured debt market has shown a fantastic appetite for real estate unsecured debt so far this year, and I expect that to continue. We have to also ask ourselves, in the context of a lower for longer mentality we saw in the debt capital markets through 2017, will that continue in 2018? The fundamentals that supported that school of thought have not yet gone away. Are we seeing a head fake in bond yields in the early part of 2018, similar to what we saw in the taper tantrum of May, June of 2013? Or is this the real move this time? In terms of impact on our cost of borrowing at CT REIT, there has been a slight increase. We issued debt in February of this year at a higher coupon than we had done in the past, but all still very manageable within the context of our business and how we're putting that capital to work.
So I think there are two things that will impact funding. One, on the cost side, I think you'll see continued pressure on the Government of Canada rate. Some of it will cause a slight increase in the cost of funding, but I think the level of competition among lenders is going to create continued pressure, and therefore you won't see any material increase in the cost of funding, and therefore that'll be a sort of a net neutral to the impact on cap rates and valuations for 2018.